See, we have already 35 people in. We'll give people a little bit of time, then we'll dive right into it. But just want to welcome you to this session hosted by the Crypto Valley Association. We'll do our intros once we have a couple more people in. Here we have possibly 150, 180 people joining. We'll give it a little bit of time. But thank you for everyone for taking your time to join the webinar today. All right, Paola, I'm gonna give it till like 50 or so, so we can dive right into this.
Amazing.
All right, looks like we've stabilized for the number of participants, so we're going to get started. So welcome everyone to this session hosted by the Crypto Valley Association. I'm Kyle Downey from Talos, head of portfolio solutions. We have with us today Paola Origel, co-founder and CEO of Hyla Fund Management. So first, thank you to the CVA for hosting and coordinating this. Thank you, Paola, for joining. We have a bunch of things to cover. We're gonna kind of run through this fireside chat for everybody. And then at the end, hopefully have time for questions. Please make use of the Q&A feature. I have that open. We'll kind of keep an eye on that. And if we have time for questions at the end, happy to address as many of those as we can. Saskia from CBA is also going to share our profiles with everyone. If you do want to reach out afterward with follow-on questions, I think both of us would be happy to continue the conversation on topics that you're really interested in. Just a very quick disclaimer, this webinar is for educational purposes only and should not be taken as either investment advice or solicitation or offer to purchase any securities. We will be touching on the topic of investment in crypto here. So Paola, just to start, love for you to introduce yourself. Tell us a little bit about the path that took you into crypto. So everyone has their own journey into the industry.
Yes, and first, thank you everyone for joining today, and thank you, Kyle, for having me, and Saskia as well. I feel very grateful for the opportunity. So my career has been taking a very interesting path. I'm originally from Mexico City, and I started my career creating and implementing e-learning platforms for big companies like Cemex. Because of that, I was brought to the US to create and implement similar e-learning platforms for retail companies like Target. After that, I switched to traditional finance in the early 2000s, where I worked for over 16 years in different capacities, primarily for family offices, hedge funds, and also as a banker for HSBC. I learned about crypto in a very early stage. I learned about Bitcoin in 2010. It was not even $1. However, I was not able to buy it. It's one of those very sad stories in crypto because it was not as accessible as it is today. And in traditional finance, you always needed to report whatever you bought. So I was very afraid of touching it. However, my curiosity got triggered, and I started going to all the meetups that started happening in Brooklyn at the time, where only computer programmers were assisting and some curious people like myself. So I started going really into the rabbit hole of the meaning of blockchain technology, and I got very passionate about it. Maybe it's because I always been very excited and passionate about technology, but also because coming from a country like Mexico, I understood the tremendous opportunity that it could give to some people, especially in terms of financial inclusion and access. So I went into the rabbit hole. At the same time, one of my best friends at the time, who was in New York as myself, Andrew Hoppin, who's one of my partners and the CIO of the funds, asked me what I thought about blockchain. We both share the same passion and vision about the technology. So I decided to go back and work in technology for a high frequency trading computer programming platform run by Arthur Whitney, who is one of the, in my opinion, one of the most powerful computer scientists alive today. He has written at least like 5 computer programming languages from scratch. So he hired me as his head of business development. And this position helped me a lot because he was exploring the possibility in applying his new computer programming language into a layer 1, meaning creating a new blockchain. So we analyzed every blockchain available. At the time, it was primarily Bitcoin and Ethereum, to really understand the potential of each of them. So I learned a lot. So in 2016, Andrew talked to me, invited me to participate in a partnership, but we didn't know where to start. We both knew that we wanted to participate in the space, but back in the day, the only common denominator that a lot of founders and managers have is that we didn't know where the technology was going. It was too new. So for us, it actually makes sense to launch a hedge fund of funds. And that's how Chainlink Capital, it used to be our name in 2018, we launched our first strategy in January 2018, what we called the Liquid Venture Fund of Funds. So now we have transitioned more, not only into hedge fund of funds, but we are building what we call a multi-manager, multi-strategy platform, where we also offered more liquid strategies. So illiquid and liquid strategies. So I'm very excited about the future, but I'll stop right there.
Yeah, so let's touch on that a little bit. So sort of the fund-of-fund structure is one approach, the multi-manager is another. How do you see the role of fund-of-fund structures in particular, and especially in crypto? Like, what's their unique value proposition for asset managers, but also for allocators?
That's a great question, and I get asked that a lot. And by the way, for a little bit more background, when we launched the fund, I thought it was going to be so easy to raise capital. For me, there was no other strategy that makes sense with the high volatility that we have in this space. But I think it's important to share the reasoning behind why we launch a fund of funds rather than going straight into a direct investment strategy. Back in 2016, when we first started considering the possibility of launching a project or a fund, Andrew was a member of the Hillary Edmund Foundation in New Zealand. He was surrounded by some of the early adopters and OGs in the blockchain space. And what stood out to him was that while everyone agreed blockchain was here to stay, no one could agree on where exactly the technology was headed. The risk was too high to place all our eggs in one basket, especially in such a new space. So we believe that a fund of funds in crypto acts like a bridge between complexity and accessibility. The crypto space is still incredibly new and rapidly evolving. And that makes it difficult for investors who might not have the specialized knowledge or resources to dive into individual crypto hedge funds. So we wanted to simplify that process. As we know, by the way, the concept of a fund of funds isn't new. It's being a tried and tested method in traditional finance. But I personally believe in crypto, it holds even more value because of how fragmented and complex this space can be. So in other words, instead of putting all your capital into a single strategy, a fund of funds spreads across multiple hedge funds, each with its own approach and sectors. So this diversification is key, especially given how volatile the crypto markets are. So if you're an allocator trying to balance risk and find alpha, it's almost impossible to track every crypto fund or carry out the necessary due diligence on all of them. And I think that's where we come in. So at Hyla, we take on that responsibility, the responsibility of finding the top managers, evaluating their strategies, and ensuring they align with not only the risk tolerance, but also the goals of our investors and potential investors. So I think the biggest value proposition here is access. Some of the highest performing crypto hedge funds have either high minimum investments or are entirely closed to new investors. And thanks to our relationships in the space, we have the second longest track record in the industry. We can open doors to those otherwise inaccessible opportunities. So even for funds that are open to investors, sometimes the minimum investments can be really high, But with us, by pooling capital, we lower that entry barrier. So, but not everything is positive, obviously, and there are some trade-offs. One common concern with a fund of funds is the additional layer of fees. Yes, you're paying the fees of the underlying hedge funds plus the management and performance fees we charge. But in many cases, we have been able to negotiate better terms because of our relationships with these managers. So while there is an extra fee layer, you are also gaining access, diversification, and expert due diligence. I kind of like to think of the fees as your value added because you're paying for expertise, risk management, opportunities that might not be available to individual investors. So I think in crypto, where regulation is still catching up and the market can be wild, our fund offers a level of that diversification that reduces some of the risk associated with single manager exposure. So for example, a good example of this, and I get excited about sharing this, is in 2022, with the fallout of FTX, most direct crypto managers had an average exposure of 16%, with some as high as 90%. For us as a fund of funds, our exposure was only above 4%. So while your returns might be slightly lower due to the extra fees, the risk of losing capitals is also much lower. So yeah, well, do you still have to digest the additional fee layer? I believe the benefits of access, diversification, and due diligence that we offer really make it worth it for those who want exposure to crypto, but they aren't quite ready to go all in on picking individual hedge funds. And let's remember that this is a 24/7 market.
So, the fund of funds, they play a role as an allocator. So you're talking to, the various funds, but you yourself are also speaking to allocators. And you spent the last 2 months traveling. I know you just very recently came back home to Mexico City. And so I'd love to kind of hear what you're hearing from investors, including about like those specific strategy interests, and just share some insights from your recent travels, particularly out in Asia with sort of it being conference season out there for blockchain.
Absolutely. By the way, I'm still the jet lag. I just came back yesterday. The jet lag's still like hitting me. So I apologize if my brain is not working properly. But yes, I have visited 6 countries in 2 months in Asia. I attended major blockchain events like Korea Blockchain Week, Token 2049, and the Network State Conference. But beyond these events, I had a chance to meet with a wide range of investors and fund managers. And really, the insights have been fascinating. What I've seen across the board is that investors are really focused on navigating today's volatile landscape, particularly with the current liquidity challenges. Everyone is hunting for alpha, but with a sharper focus on correlated strategies that can act as a hedge against broader macro risk. And it makes sense, given that the global financial markets are still feeling the impact of the elevated interest rates and the inflationary pressures. One thing that really stood out to me was the distinct profile of investors I encounter and I met with. For high net worth individuals and smaller investors, liquidity is a key concern. A lot of them are frustrated because they are stuck in investments they made a few years back, or their capital is tied up in venture funds with long lockup periods. So they need flexibility. Now, on the flip side, larger family offices and asset managers are taking advantage of this environment. They're more leveraged to negotiate better terms for direct investments, and they're scooping up deals at lower valuations. This pattern was consistent, by the way, across both crypto and traditional investors. Now, in terms of what strategies are catching attention, I noticed a couple of things depending on the type of investment. So I'll say that for those allocating to crypto funds, market-neutral strategies and quantitative or AI-driven models are big right now. Market-neutral strategies take long and short positions to neutralize market exposure, allowing investors to profit from the relative performance of individual assets. This is especially appealing, obviously, in volatile markets like crypto. Now, quant and AI models, which exploit market inefficiency across different asset classes, are also gaining popularity because they offer uncorrelated returns. Now, for non-crypto investors, what I've seen or what they share with me is that commodity-focused funds are becoming more attractive. Commodities like gold, silver, and energy products have a local relation with traditional equities, making them great inflation hedges. Also, event-driven strategies, which focus on corporate events like mergers and acquisitions, are also right now on the rise since they offer returns that are tied to broader market movements. On the direct investment side, I think the major trend continues to be in artificial intelligence. It's still the hottest sector, I think, followed by cybersecurity. And I really want to emphasize this. Cybersecurity, cyber attacks is a concern across the board for small and large investors, including family offices. Also, alternative healthcare, I feel like it's gaining more traction as well. On the blockchain side, I'm seeing continued interest in areas like gaming. And again, I'm talking about Asia specifically, and I think gaming is important because historically, Seoul has been an innovation hub for important gaming, even before blockchain. Also, I've seen continued interest in decentralized finance and tokenization of real-world assets like RWA as well, though I think there's still a lot of debate about what RWA tokenization really means in practice. Two other trends that grab my attention that I was not expecting they will be that strong during these interviews and meetings that I had are the growing interest in frontier markets like Southeast Asia, Africa, and Latin America, as well as investment centered more around community building and research into human connectivity and consciousness. A great example of this is a presentation that Vitalik Buterin made during the Network State Conference with his project Sulalu, which is a pop-up city. This project brings together members of the Ethereum community to explore topics like human longevity and collective problem solving. So it's very interesting to me because I've been talking about this for a few years now. I've been saying how as we implement these emerging technologies more across the world, we will start, there's no question about this, and maybe this is a little bit controversial, but there's no question about it that we will get replaced by AI. Now, the interesting thing here is, as we get replaced for AI, what are we gonna do with our time? And I think these type of communities will make more sense then. I think the importance of understanding what human consciousness really means versus something created by artificial intelligence is becoming more and more relevant. And what it really means, human connectivity and creating communities and connection. So I think that's fascinating. So that's overall what I observe.
So I wanted to pull on two things that you referred to there. The first one was just about this concept of liquid venture. And this kind of alternative category, because we did see this pullback post FTX where we saw like crypto hedge funds converting to venture funds, people preferring only token investments. Like it was almost like a sign of conservatism or like backlash of like, well, if if I'm going to take this risk, I want the 100x out of that. But you often talk about this concept of liquid venture, and I'd love for you to elaborate on that a little bit as a strategy and like how you see sort of the relationship between the more liquid funds and the VC funds in the space.
Yeah, that is such an interesting question because we've been talking about liquid venture since pretty much 2017. So overall at Hyla, what we observe is, or we also notice, is that there's a continued strong demand from our investors for greater liquidity. Not only in Asia, right? So all over the world. In terms of, and I'll make a pause here and I will talk about the liquid venture specifically, that's your question. But I also want to mention that because of the appetite of, or the strong demand of greater liquidity. That's why our partnership with Amphibian Capital and their market neutral fund of funds is so valuable, because really their team has been delivering consistent positive returns for almost 2 years. So again, I mean, this sounds like a pitch, but it's not. But I highly recommend you to, if there are any people interested or curious about these strategies, to check out their strategies at the website at amphibiancapital.com, because I think that both strategies in a platform like the one that we are building actually makes sense, because we're really positioned to offer like an all-weather portfolio for institutional investors interested in crypto. Okay, with that said, that's a pause. So on our side, on the Hyla side, as I said before, we have been managing the liquid venture strategy with great success. It's a fund of funds. This strategy is really unique to the digital asset space, because in traditional finance, you often have to wait for years until an IPO or an acquisition for liquidity. But in the blockchain world, projects can issue tokens that are tradable much earlier, giving investors access to liquidity at a much faster pace. So to be clear, also, liquid venture doesn't offer 100% liquidity in early stage blockchain projects, but it does provide far more flexibility compared to traditional venture capital. We are able to acquire pre-market tokens at a steep discount. I mean, sometimes even like between 80 and 90% below the launch price. And when these tokens hit the market, we've seen returns as high as 10 to 100x. So these tokens often come with vesting periods. So it's not easy to manage these type of strategies. And once again, I want to emphasize the fact that we are a hedge fund of funds, so we rely on our underlying managers to manage the positions and the liquidity terms. And I believe this is a very critical component of these strategies. But the reality is that the liquidity of our underlying managers that they offer in this space is something that just doesn't exist in traditional venture. Also, there's a new element playing into the space, right? And it's very new, so I don't think I can speak exactly how that's going to play out. But let's not forget that AI has a potential to reshape the venture capital landscape as well. We're seeing that it can enhance decision-making processes, it can improve some of the risk management, it can increase operational efficiency, and facilitating, in some cases, access to investment opportunities. I think this is not only potentially affecting the liquid venture strategies. I think both liquid venture and traditional venture can benefit from these advancements. But the impact may be particularly pronounced in liquid venture, where the agility and speed are essential. So I think a very important consideration, for the founders as well, because I think I've been focusing and talking more about on the investor side. But I think while venture capital can be a great fit for some startups, it's not one size fits all, right? And many startups, especially those in new industries or with unconventional business models, may not align well with a traditional venture capital timelines or expectations. And I think in that sense, liquid venture capital models can enable different funding mechanisms that cater to a broader array of startups. And these will work by allowing more flexible investment structures, maybe such as like crowdfunding, and liquid venture can also democratize access to capital and potentially lead to asymmetric returns that retail investors usually can access. So in other words, I think like startups with liquid venture, startups can iterate more quickly without the long-term commitments typical of traditional venture. And this flexibility is it has a special advantage for some sectors like software businesses, which can change and adapt fast based on the market feedback.
So kind of going back to the allocators. So like your traditional crypto hedge fund allocators tend to be high net worth individuals, crypto OGs, Bitcoin whales, et cetera. Family offices have played a big role. We had a question, and by the way, to encourage everyone, I saw one hand raised, but please just put into the Q&A. I'm keeping half an eye on the questions, and I'll try to weave in your questions as well, so we can keep this interactive. What do you kind of see as the risk appetite? Like, do you see greater allocations coming from the family offices? Is it still mostly like crypto angels, like getting into the space again a little bit more post FTX? Where are you seeing the pull, and like where are people's heads in terms of like allocating to this space, to crypto?
As I said before, Kyle, I think the appetite, it depends on the profile of the investor. For family offices, I just gave an interview, very specialized, about family offices and the difference in generational wealth and how different generations approach investment in a very different way. I met with a few family offices, and they're still very interesting in impact investment, without saying not necessarily ESG, but they're concerned about climate change. They are definitely looking and seeking the alpha, but they also are much more mindful of where the alpha is coming from. So when it comes down to crypto, unfortunately, we'll still have to deal with a very pure reputation. And what I observe, when I attend all these conferences around the world, and I have to say it and I have to call it out, and I'm part of the crypto space and the blockchain space. We need to step it up. We need to change the way we launch or we present ourselves in the crypto world with the crypto and the blockchain events that surround some of these conferences. The constant feedback that I receive, especially from family offices and larger institutional investors, is that yes, to answer your question, they're interested. Yes, they know that even like big asset management firms, their investors and their clients, they want to have exposure to crypto and blockchain, but they don't know where to begin. And the issue is that a lot of these people are attending this conference with the hopes of meeting potential projects or managers to invest in. And when they go and they encounter some very, I don't know, techno-driven and crazy and wild crypto events, they get turned off and they don't know what to do. So
Right.
the interest is there. To answer your question, I don't think I answered your question correctly, but the interest is there, both from high net worth individuals and family offices. I just think that the process of investment is very different. I think naturally, and again, going back to the amphibian capital funds, it is because they are Bitcoin and Ethereum denominated. We have two separate funds. Crypto whales understand the product. Crypto people, they already understand the benefits of blockchain because they had incredibly high returns, and that's how they generated the wealth. So they're not shy about this space. They're not shy to taking some risk. Now, even them, they're taking a step back again in terms of liquidity and in terms of the strategies and the risk appetite. That's why I mentioned before, market neutral strategies are the number one, I think, strategy that they're looking at. For a more traditional investor, they're very cautious, and I think they're sitting more on the sidelines, especially they're waiting for the results of the US elections in November.
So another point to like pull back from your earlier comments, just on tokenized assets and crypto, and this is controversial, at least within the crypto industry. There's a certain amount of shade throwing that happens along the lines of, well, when things are bad, people talk about like private blockchains and tokenized assets, and we go back to the fun stuff when the market gets better. I'd love to hear your perspective on the role of those. A couple of them we've started to see product market fit, but there have been a lot of kind of more proof of concept than anything else. What do you see that's interesting in that RWA space? Do you think it is here to stay? And how do you see how it relates to crypto? Like, is crypto a transient thing, or does it kind of, getting back to your point about liquid venture, perhaps have a future as an alternative fundraising model?
Yeah, that's a very interesting question. I think yes. I think we're witnessing a significant momentum in the tokenization, of real world assets, but especially with yield bearing assets, right? Like bonds and treasuries. I think that these markets are already highly liquid and efficient, making them prime candidates for tokenization. However, when you look beyond that, the broader market is still evolving. And I don't think I think the challenge isn't necessarily the technology or liquidity. Those are progressing. That's my opinion. I think it's more about demonstrating the added value and clarifying the regulatory landscape. I think in this sense, I believe like major players like the New York Stock Exchange and NASDAQ and other crypto exchanges might be the ones to lead the charge in tokenization. If they can show how tokenization positively impacts their bottom line, I think we could start seeing some real shifts. But I think convincing institutional investors to overhaul their back-end systems will take time. And tokenization needs to offer compelling advantages. For example, like how do we persuade institutions to adopt technology that relies on decentralized validation? These transactions are transparent for just a moment before they get finalized, right? So they raise trust issues. So in order to unlock larger scale adoption, I think we need a careful balance between transparency, security, and privacy, especially if tokenization is to fit into highly regulated financial markets. But I personally believe that the potential integration with DeFi is incredibly promising. I think tokenized assets can serve as collateral in decentralized systems. They can provide liquidity and around-the-clock markets, advantages that traditional finance simply can't have. But we really need to focus on product market fit to ensure that the end user experiences are seamless. So I truly believe that the real growth will come from tokenized assets that have the greatest inefficiencies today. Think about alternative assets like real estate, collectibles, and private equity. Tokenization can make a tangible impact by solving back office inefficiencies and creating a secondary market. Now, when we talk about real estate, and it's $1 trillion market, especially when you talk about tokenization of real estate, I think we're not there yet. And we're not there yet because the complexity of the regulation of the different jurisdictions around the world is a big challenge. But I think we're making some progress. But I'm not sure we're there. And I think for all of this innovation to happen, we need a clear legal framework. That's why I'm cautious. That's why I'm always cautious about using the term completely decentralized. I feel and I prefer that better distributor is a better term, because I think we really need an in-between stage between a fully centralized world to go to a fully decentralized world. I think that we cannot transition from this fully decentralized system to a fully decentralized system overnight. And that evolution is happening now, but it is a critical part of the process. So I don't know if I answered your question, but I think in my mind, we're not there yet.
Yeah, and I think real estate is probably a good example of that. Someone pointed out to me, there's still towns here in the US with paper record keeping. There's certain things that have to happen. They're almost prerequisite for some of these things that people got excited about early on.
Yes.
So before we
I'm so sorry that I interrupted, but I was going to bring up also, right, and this is related to my trip in Asia. We get excited, all over the world, talking about this type of solutions, and RWA, of course, is the newest trend. But what I would invite people to really think about is that, for example, in Asia, and I was very impressed by it, especially in China, is a completely cashless society. All I needed to walk around and navigate China was my phone. In contrast, when you come back to America, and I'm talking about the whole continent, we still have so many inefficiencies. Like you say, not only real estate, but like the healthcare industry, supply chain, we still rely on paper. We still rely on paper currency and coins. We have to carry them around. We still rely on carrying our ID. I mean, it blows my mind that when we go to a doctor's appointment, we still have to write on a piece of paper our social security number, and we don't know where that's going, right? So there needs to be some transition, and there needs to be something in between. Now, it's not impossible. It happened in China, right? I mean, these technological revolution and application, specifically in that economy, happened less than 20 years ago, which for me is fascinating. It's incredible. So with that say, I understand that with these emerging technologies, it could happen, but we need to start. I think the right word is patience. We need to have more patience, with this space and with these technologies. I think we need to be more mindful of that. Sorry, I interrupted you, Kyle.
Yeah, that's quite all right. It's kind of a good point about some of the complexities, though, even for these digital solutions. One key part for a fund of fund, or really anyone evaluating a crypto hedge fund, is the operational side of things. The processes that they have in place. So, on our side, we're building a portfolio management system to help automate a lot of that. So I'm always interested to understand, particularly from the allocator's side, what are the risks that you most worry about? What do you worry about those fund managers not being able to handle in terms of the operational processes that maybe are less of a worry when sort of you have all of those pieces from traditional finance that fund managers have relied upon to kind of keep things going smoothly, as opposed to, say, dealing with a bearer asset and some of the cybersecurity risks that you had alluded to before.
Absolutely. I think that operational due diligence, or ODD, is a huge part of a funds manager's job, but especially for a fund manager. And especially even more in the crypto space, because it's such a fast-paced and volatile environment that ODD becomes essential in managing all the risk. So when it comes down to this risk, several key concerns stand out for me. The first one is counterparty risk. In a landscape with market dynamics and participants can change overnight, as we have seen, it's vital that we properly vet our counterparties. Without that due diligence, we are opening ourselves up to significant exposure. We've seen, with what happened in the past with FTX is a major example, but there are many others. Another critical risk is liquidity risk. Even if an asset appears to have decent liquidity on the surface, that can go away much faster in crypto markets compared to traditional ones. And we saw that with the aftermath of the FTX incident. This has lighted the need, obviously, to find solutions that specifically to separate custody from exchange functions, which makes sense, right? Because that's exactly the way it works in traditional finance. I think this is crucial for risk mitigation. As I said, similar to practice we see in traditional finance, where custodians are often highly regulated banks. As for controls, I think that robust, going back to cybersecurity measures, they're really not negotiable for us. I think, like, given the frequency of attacks we've seen, protecting assets is very, very important. We also need clear and transparent governance structures, especially when dealing with decentralized finance protocols. I think effective risk management is possible without a deep is impossible without a deep understanding of the technical architecture involved. So, and the only way to know this is to have extremely good communication with everyone involved. So for us on our side as a fund of funds, constant dialogue with our fund managers is essential. We need to regularly review and update, for example, signatories on custody accounts. We have to ensure everyone understands who has access to key wallets and security systems. And what we observed with some of the, I would say, mistakes in the past is that it's not often the technology that's the weak link. Rather, it's human error that can leave a fund very vulnerable. That's why a strong due diligence process from the very beginning, particularly when we are selecting our underlying managers, is so important. So I think, like, to wrap it up, or like in your case, I think it's important to consider the overall landscape, for due diligence, especially for our managers. We emphasize essential controls to strengthen our risk management framework constantly. And I think there are 8 controls that come to mind right now. One is having a clear risk assessment framework. Diversification is key, and I keep talking about diversification, and that's very important, on the fund level, but also, in the funds that we invest. A stress testing and a scenario analysis is very important. Real-time risk monitoring is also another consideration. Compliance controls, cybersecurity measures, communication, as I said. And the last but not least important, that I think, like, sometimes we don't tend to look in the crypto space, that it was very much enforced in traditional finance, the world that I come from, is having regular training and awareness programs, not only at the managing level, but also the whole team.
Yeah, I mean, the human element, often the technology is ahead of the policy and the training, and the practices and the culture. And I've heard this from multiple allocators, people on the insurance side, that the question on their minds is not like, what self-custody wallet are you using? It's like, are you using 203 signatures? Do you have other measures in place? What are your backups if keys are lost? These are things that, like, they're not necessarily technology specific. They come up more with crypto, but they are kind of some unique challenges that you need to have those in place. We saw managers with, like, literally tens of millions of dollars locked up on FTX who weren't thinking about that exchange custodian separation that you were talking about before. So, quite a few hazards, and those controls are essential.
Yes.
Um,
And interesting enough, I would just like to add, because again, crypto has such a bad reputation, and the headlines also, like, another hacker and they lost another 100 million and so forth. But something that's very interesting to me is, again, it's not the technology's fault, but furthermore, they're actually able to identify those hacks, and because it's blockchain technology, because we're able to trace down, when it happens and how it happens. In traditional finance, it happens all the time. We just don't hear about it that often, because they're not able, in most cases, they're not even able to track it down. So I think it's important also to remember that.
Yeah, to me, one of the great ironies is the degree to which we've reproduced some problems of opacity and lack of transparency in a space, thing around, like, some of the CeFi lenders, et cetera, that is built on decentralization and transparency. But there certainly are places where it has done significantly better than TradFi, and that's the whole KYC AML aspect of it. I think people don't talk about that enough. Um, so, to kind of wrapping up, like, looking at these different structures, we kind of started with small specialist crypto funds that evolved to deal with these unique operational complexities. Where do you see it going? Is it the platform model of, like, the Millenniums or Balyasnys of the world? Is it decentralizing via DeFi? Did the funds go away? Or some combination. What do you see as the future path for fund structure?
I think it's a mix of all of the above that you mentioned. I think we're seeing a small, specialist crypto hedge funds continuing to evolve, because they have become adept at navigating the operational complexities of this market. But I do think we'll see the emergence of platform type models from larger asset managers, firms with the resources to scale these innovations. And I'm seeing more and more traditional financial asset managers launching crypto funds. So adding a crypto fund to their already, billion-dollar, AUM platform, and it actually makes sense. At the same time, I think the DeFi space will continue to grow and decentralize, as I said, with a transition period, but institutional players will drive a lot of the future adoptions. I think it's hard to say if there's one clear direction the entire asset management world is moving in. I think rather I see the ecosystem becoming more multifaceted with specialist managers, larger platforms, and these centralized structures are all playing an important role in the blockchain crypto space. And frankly, personally, I think what makes this space so exciting.
That's probably a great place to end, wrap up. I've tried to weave in questions from everyone. If you throw in any in the chat, happy to address it before the end. But why don't we finish there with what most excites you in terms of innovation? The wildest project that you've seen, or things that you think are unique applications of the technology that people might not have come across and might want to explore.
Wow. I mean, there's so much happening right now. I think it's hard for me to pick just one. So I will probably break it down into a few categories because there are different kind of like wild out there. For me personally, I'm fascinated by what's happening in augmented reality and extended reality. As someone who loves art and fashion, I've seen some mind-blowing projects that blend design with XR. I mean, imagine the future of fashion where you wear clothes with moving digital elements. And I was actually in Tokyo, and I went to the Y3 store, and they already have clothing that it can interact with your phone and things can come out of your clothes. I think that's fascinating. Again, that's on the more fun, lighter, development of technology, but I think it's just incredible. I also met with the founder of a very interesting and powerful project that will be released next year in Singapore that is using VR to reinvent the luxury retail world. And again, this is not just a concept. A major luxury group is already on board and behind of these projects. I'm excited to see what that looks like. And then on a more serious note, though maybe less fun, there are a few I saw in Texas specifically, a few defense simulators that are just jaw-dropping. They're using hyper-realistic environments for training and strategy. And while I'm not sure they're necessarily great for humanity, I have to say that the tech behind them is very, very impressive. But in terms of projects that I am the most passionate about and that I can see they will have real global impact, one that really stood out to me was in Brazil, where they are using AI and blockchain to streamline agriculture supply chain. So think about how much food gets wasted due to the delays at ports and inefficiencies in transport. It's not only capital wasted, it's also food. So this project is actually tackling that project head on by optimizing the entire process, reducing waste, and ultimately, as I said, saving both food and money. So that's a kind of innovation that has a potential to make a massive difference globally. And that's the type of innovation that I'm most excited about. And this is one of the reasons we are launching next year a direct venture strategy for Latin America, because I do believe that these technologies will get implemented faster and more efficient in markets where they're needed, like front-end markets, like I mentioned before, Southeast Asia, Africa, and LATAM as well. So I think these last project that I talk about in Brazil with supply chain, what is very interesting is that it ties into what we're seeing in the financial industry too. These are projects that use blockchain to streamline payment solutions. So at the end, what is fascinating to me about the blockchain space is that everything is all connected, and these innovations are starting to reshape entire industries. And that's the reason why I joined this space. So that's very exciting. It's a very exciting time to live in.
All right, Paula, I think I know you have something after this, and do not want to hold you up. Thank you so much for the time. Thank you for everyone for joining the webinar. And thank you once again to our hosts at the CVA. And if you are interested to follow up, you can contact through the CVA. You can contact Paula or myself directly. Our contact information will be made available in terms of LinkedIn.
Thank you,
All right.
everyone.
Thank you, everyone.
Bye.